David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, President of Keystone Financial Group here in Trussville, to discuss eliminating the risk that could undermine your financial plan. David, thanks so much for being with us today. You know, most of our interviews seem to focus on the implementation side of a financial plan. We've discussed market and economic factors that impact how investment accounts are managed, but today we're going to talk about the process of planning itself and addressing risk that could undermine those efforts, correct?
That's correct. We've talked in the past about implementation being driven by the underlying planning work. Relative to the assumptions being made, we could construct an incredibly holistic plan and implement the plan with an effective mix of tools and platforms. But that plan will only be as solid as the risks that we eliminate. Within our planning output, we make assumptions pertaining to income and deferrals, potential long-term rates of growth, taxation, inflation, and other metrics. We attempt to codify objectives within a financial blueprint that spans the duration of a given client's life. And if everything unfolds perfectly, then the objective will likely be realized. However, if we aren't cognizant of real and present dangers that could undermine the fruition of our planning work, or if we underprepare for these dangers, then we are assuming unnecessary risks.
Well, that makes sense, David. Can you elaborate on what these risks are and how they could undermine holistic planning efforts?
Absolutely. Let's start with an obvious risk, the replacement of an economic footprint, as I like to call it. Among other things, when building a financial plan, we assume that both clients will live long enough to defer planned amounts into their qualified plans, and those deferrals will likely receive matching from their employer, and we will have many years to enjoy tax-deferred earnings on those deferrals. We assume that our clients will continue to pay into the Social Security Trust and at some point enjoy a durable stream of income at retirement. We also assume that as these amounts grow, withdrawals will be deferred until some point in the post-retirement years so that needs of inflation-adjusted income are met. What happens if one of the parties involved in the plan dies suddenly? How might that change the planning assumptions? Clearly, there will be no further deferrals into a qualified plan. We will not have the earnings and the matching on those deferrals that aren't being made, and therefore qualified plan balances will be much smaller by the same point in retirement for the surviving spouse. But it gets worse. If the deceased spouse had inadequate life insurance, then maybe the surviving spouse is then forced to take early withdrawals from that qualified account, thus jeopardizing the degree by which income could be supported in retirement for the survivor. Although in most cases a surviving spouse can choose the greater of their own Social Security record or that of a deceased spouse, they are nonetheless left with only one durable stream of Social Security income, while the plan assumed that the household would have two streams of Social Security income. These are just a few very obvious ways that an untimely death could severely undermine the fruition of planning objectives for a surviving spouse. What would it take to replace the economic footprint of a spouse? Well, let me offer this simple example. Let's assume that a 45-year-old person is realizing $100,000 of net after-tax income. This is the income upon which the household depends for meeting expenses. If that spouse were to pass away, I would need $2 million of life insurance death benefit just to replace that net after-tax income. We haven't paid off a mortgage. We haven't completed a child's 529 college savings plan. We haven't retired debt of any other kind. If I took a $2 million income tax-free death benefit, depending on the chosen platform, the yield could replace the $100,000 of net after-tax income once earned by the deceased spouse. Unfortunately, many people are underinsured, believing that such needs will be met by an employer's group term insurance plan or an individually held piece of insurance sufficient enough only to cover the mortgage. The economic footprint of someone is much broader and much more deep than just the indemnification of debt. So the first risk that I strongly encourage clients to mitigate is that of an untimely death, to replace the economic footprint of that client should death occur prior to the fruition of planning goals. If we've addressed this risk, then accounts earmarked for retirement can remain intact, while needs of income are met by the economic footprint replacement of life insurance.
Well, thank you for that insight, David. And yes, that seems like a significant point of planning that should be addressed adequately. Are there other risks of loss of which people should be mindful when constructing a financial plan?
Yes, indeed. As I just described, it is important to indemnify against the risk of an untimely death, but it is equally important to indemnify against the risk that income could be lost prior to the fruition of planning goals. Disability insurance is something that is often overlooked and taken for granted. The difference between life insurance and disability insurance is that with a long-term disability, you're still alive and here to experience the pain of a potential bankruptcy or a foreclosure or other catastrophic event that could result from the permanent loss of income. These aren't rhetorical questions. Should a disability preclude you from earning an income, how would your household expenses be met? How difficult would it be to borrow money from a bank without a documentable income stream? Would a spouse have to work multiple jobs? Would you be forced to consider borrowing from family members? Qualified plan balances upon which we had planned for the support of your income in retirement will not be there if you have no income from which to defer. Indeed, at a certain point, you may be compelled to withdraw from those qualified plans in order to meet monthly needs of living. Furthermore, we haven't even begun to discuss how you might handle the higher expenses of medical care on top of routine and sundry monthly expenses. Unfortunately, it seems to me that many people are left with the impression that it could never happen to them. Indeed, a life-altering catastrophic event can happen in the blink of an eye. If you work for an employer that offers disability insurance on a guaranteed standard issue basis, that's a good thing. Very often, however, the limits and provisions of such plans aren't sufficient to truly meet the need at hand. Conversely, individually held policies can offer other forms of coverage typically not found with easily obtained group plans. This would include coverage for a partial loss of income, rehabilitation benefits, cost of living adjustments, and a definition of own occupation that could last for the duration of your career. I strongly encourage clients to not only consider life insurance, but also disability insurance before committing to following a holistic financial plan. If you haven't adequately covered these two areas, then you're needlessly leaving the outcome of the plan in jeopardy.
So addressing the needs of life and disability insurance is a vital part of any holistic financial plan. What about needs of long-term care insurance? Is that equally important as well?
It sure is. Sometimes people associate needs of long-term care with being later in life. And frankly, that's not entirely true. I know of a handful of examples where people younger than myself are receiving long-term care resulting from injuries or sickness. More and more often, I'm finding that adult children nearing the fruition of their working years are now struggling with the financial reality that comes with caring for aging parents who had not adequately addressed needs of long-term care. This is serving as motivation for them to assess that risk within their own plan. Fortunately, many of the life insurance policies being issued by companies today can serve multiple roles. We call these hybrid life insurance policies. Very often, we have addressed multiple needs of risk indemnification with one hybrid policy as we have sought to minimize threats that could come against the fruition of planning objectives. In conclusion, we are perpetually working with our clients as it pertains to the investment implementation of multifaceted financial plans that we have constructed for the achievement of their objectives. All of that work could be undermined, however, if we have cast an oblivious eye to the very real risk of loss that could undermine the achievement of those objectives. I would strongly encourage your viewers to not simply be satisfied with what they believe to be adequate coverage. Engage a professional financial planner who is qualified to stress test those assumptions before something catastrophic provides that stress test for you. You may find that you've been underinsured for a long time, and thankfully, that you are also in a position to address the risks that could undermine the objectives for which you're planning.
Well, David, thanks so much for this really important information today. And for additional information, David may be reached through the means listed upon the following screen. For Trustful Tribune, I'm Brannon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.